You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time for the funkiest show here on the old network, the last show of our broadcast and recording week. Yes, it's time for TWIFO, the program where we look back at the week that was and indeed still is in all things futures options. So we're talking, maybe we'll sneak in some lean hogs, some crude, some gold. Who knows what the heck will be on the docket, though. I probably could say with some certainty that gold will be on there this week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. And all of you listening on the podcast, we welcome you by your platform of choice. And, of course, if you can make it, we have a little bonus for you hardcores out there who always complain, I want to listen to it right away. I don't want to wait till the podcast. Well, we got you covered. Join us live via Mixlr, MIXLR, every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. And you, too, can hear how the sausage is made, ask questions, make fun comments, all that good stuff. And, of course, however you listen, live after the fact, make sure you hit us up, questions, comments, insights. Maybe you have a product, a crazy product you'd like us to break down on the show. We don't cover it that often. You let us know. We like to hear that kind of thing. We do read all of your questions, and we try to get to as many as we can on the old show. And joining me on the old program, my cohort, my partner in crime, the futures options yin, to my yang, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform I like to use once or twice called Quick Strike. Mr. Nick, welcome back to the show, sir.
Hey, we're already back. Is it Friday again already? I don't even know right now.
We wake you up from your weekly nap once a week, sir,
quick.
to do TWIFO.
I was hibernating. I'm still worn out after that Cub game. I stayed up for like 90 minutes after it watching post game, and then I'm still tired. So go Cubs.
Yeah, I didn't see it. I heard the tales. after the fact. Obviously.
Good game. It's a good game.
One of the most epic comebacks / meltdown / call it what you will in baseball. I guess it depends on what side of the fence, whether it was a comeback or a meltdown, right? If you're a Washington fan, probably a bit of a meltdown. If you're a Cubs fan, great comeback. So yeah, a little bit of both there. Interesting stuff there. Speaking of interesting stuff, let's get to it. Senior Nick, let's start it off. A lot of people were responding to what their thoughts on our gold trade last. Maybe we'll filter some of these up from the listener mail. Now, a lot of people had different ideas. Of course, we were talking last week, you remember, listeners, with the futures around 1275. We saw paper coming in, so much so that Nick and I weren't sure if the prints were real at first. We can now conclude that they were indeed real. Paper coming in and trading with the futures again, 1275, the Dees 2018 2000. They bought the 7,500, or right about maybe 7,650, something like that, of the 2,000 calls. Then they sold, apparently, about same number, 7,500 or so, of the 2,600 calls. So crazy, outlandish, weird, very optimistic, but not at all something that would, maybe, well, it would make our list, but it wouldn't. The kicker was what came next when they also came in. And I believe, and Nick might have some more color on this, looks like they bought also 15,000 of the Dees 2018 3,000 calls, and they used those. Sorry, people walking around here in the studio, listeners. But they bought 15,000 of those and doing all that. So if it looks like, as it went up as printed, looks like they bought that vertical, which already is very outlandish. And then on top of that, they came in, and I suppose in a peak, a fit of all things crazy goldness, they got to have more. They said, well, wait a minute. That vertical by itself isn't bullish enough. We need to add a kicker of 2x to what we did on the spread already. So we bought 7,500 of the spread. Let's do 2x and buy 15,000 of the 3,000 calls. And so if it did go up as that, then it opens the mind to all sorts of other possibilities. Obviously, someone out there saying, you know what, I'm going to pound this bullish vertical, but then let's add a kicker. Look, what if we're not bullish enough? What if gold moves more aggressively than this? We have to be prepared. So let's put on 15,000 in case we blow north of the 3,000 handle in a little over a year and 2 months. So yeah, 1275. So that's over two. It's about a 2.5x move in the span of a year and a half. Could gold do it? Crazier things have happened, but it would take quite a bit. Steve on Twitter is saying this is just clearly an Armageddon trade. He calls it. I could see some of that. Abad saying, what would it take? Interesting for that gold trade to pay off and the futures to hit 3,000. We'll get into that in a second. Tim John saying it's time to bust out the zombie apocalypse gear. I think that guy put on the gold trade from his disaster bunker. I like that one. That might get my little comment of the week. I'm partial to a good zombie apocalypse. Nick, maybe we'll start there. I know you've been digging for a little bit of color. Have you managed to unearth anything more about this trade since we talked last week?
No, I asked around over for the people that I knew, or from the people that I knew that are in charge of this market at a variety of places, and nobody really had anything. And to your point, it got what I did try to verify over at the CME in terms of how blocks are entered is, does the initiator of the trade have to call in and say the direction that they did it? So I'm assuming that that's the case. I didn't get an answer, but with that said, you're right. Then it was a purchase, and the funny thing, I guess, is that they paid two prices. Actually, they did 3750 by 7500 at 3, and then 3750 by 7500 at 3.1. So they not only, you would think they could have gotten all they wanted at 3, but apparently they couldn't get all they wanted at 3. So they paid up to 3.1. So yeah, really kind of nutso. The gold, the 3,000 call is only 10 cents. and the 2600 call is not much more than that according to how they enter the trade. So I mean, or that's the minimum price. So really sort of crazy. And I really wish we'll have to keep investigating and see if we can figure out why that happened, because I'm not exactly sure. It just seems like there's so, that's a long time to prepare for the apocalypse. So you probably could move it up on the calendar a little bit and prepare a little bit more easily and pay just as much for the same kind of thing, and maybe even make some money before the apocalypse occurs, So I'm not real sure what was going on there.
So you're on board then with that interpretation that it was indeed buying the vertical and then also buying the 2x of the calls on the upside. They weren't overriding those or something like that.
Price-wise, that has to be the case. Somebody bought it, somebody sold it. I think there obviously was a RFQ out there, which a request for quote for people that aren't familiar with that acronym, and somebody quoted them out there and said, I've got 3750 by 7,500 at 3, and then they lifted them, and then somebody offered to go, well, I got same amount behind that at 310. So I'm not sure. That just doesn't seem like I got to believe that there's going to be a tremendous number of opportunities to cover that or hedge it prior to that even getting close.
Yeah, I got to imagine a lot of people were lining up to be on the other side of that trade. Oh, me too. I'll be there. You need some more of those? I'll give you some more of that vertical and certainly some more of those calls. You're right. You could hedge that in any number of ways and look pretty good. I guess we'll filter up a couple of these questions now, and we'll save some of the rest for later. I like this one from Abad. What would it take, really, for that gold trade to pay off and the futures to hit 3,000? That's a good question. You were kind of joking about the zombie apocalypse, but it would take an extreme event of a maybe not quite that magnitude, but a pronounced broad catastrophe in the market and elsewhere to drive that quote unquote flight to quality, flight into those risk assets like gold. Obviously, a move like that to 3,000, that's beyond just the Fed doing something with rates. That takes it to another level. Even if the Fed went, something crazy happened on the Fed rate hike schedule, that still could account, I don't think, for that aggressive of a move in gold. It would really need to be something, broadly disastrous to really move us there. Would you concur, Nick?
Well, yeah. I mean, it would essentially. I think it wouldn't mean like a devaluation of every currency that existed, right? And then that would be the only thing of value as a hard asset. We've never even been close to that, right? So, I don't get it. We see that kind of stuff every once in a while in the commodities, and who knows? Maybe what is it? We're already in the fourth quarter here. Who knows what people can get away with, right? In terms of hedging a portfolio. I have no idea what they're thinking with that kind of trade. I really don't. Only because if you had a play and you had 3 ticks to spend, there's a lot better places to spend 3 ticks. Even if you bought the old high 1800s, I mean, I'm sure you could find a strike somewhere relatively close on the term structure to get near those highs. So don't know. I don't know if that pays off. Pays off for the guy that sold it probably, or the gal that sold it, but I'm not exactly sure. I don't even know. I mean, really, we should ask Eric one day, Eric Norland over at CME, to see what he thinks about what exactly would you even need gold anymore if people would be pulling gold out of their teeth at that point if it was trading $3,000 an ounce. So I'm not exactly sure what's up with that.
Yeah, you've gone beyond like the reserve risk asset level to something, like that is almost zombie apocalypse. You need that hard asset to survive in the brutal wasteland of modern life now, something along those lines. That might be a good question for Eric. He's big on the structural drivers of pricing in crude and gold and things like that. So maybe we will, next time we bring him on, we'll have to pick his brain on what he thinks about this, shall we say, outlandish. Love to hear your thoughts too. You guys obviously weighed in. A lot of you think it's, shall we say, on the tinfoil hat side of the spectrum, but maybe you got other thoughts. Let us know. Hit us up. If you're listening live, you could chime in as well, or via the old social medias. Let's break down some of what we're seeing this week in gold. Spoilers, nothing more on the DEES 2018 front for this week anyway. The biggest trade out in DEES 2018 this week is 140 lot of the 17 half calls. Aggressive, sure. Upside gold buggy, yeah, nowhere near what we saw last week. Instead, this week, number one with the bullet comes in Nove. Listeners out here in gold with the Nove. Actually, before we even get to that, let's break down what we saw this week. Obviously, gold looking a little bit better. Not quite what our friend needs for that trade to pay off, but up about 30 handles this week. So we were about 1275 last week, right around 1305 this week up here. So we're back in that 1300 range. That's got to put a bit of a smile back on the old gold bug's face. I know once we broke to that 1300 level, a lot of people were down in the dumps on that side of the fence. So a little bit rally north here. Maybe that's that. This is not quite back to where we were, but it's a start at least, up about 2% change, 2 and change percent this week here out there in the big contracts. And of course, we know in general, usually a move to the upside usually equates to a bit of an increase here in gold, but this kind of move up didn't really equate to much. Actually, a little bit of a come off here, as I guess they weren't priced in a lot as aggressive on the calls as they have been. Usually that call skew is very aggressive. Nick will get into more of it in a bit when he breaks down the quick skew out here in gold. But this week we saw actually vol coming off a little bit slightly. It's close to unched really across the board. So I wouldn't call this a vol crushing or anything along those lines. But if you were expecting a move up the chain and for vol to get a little bit firmer, that isn't the case. So in that case, it actually is a little bit more of an aggressive decrease than perhaps you would initially assume. And going out here to what was number one with the bullet, like we said, it was the Nove 1270 puts. So back where we were at the start of the week, right around those levels is where the action was. About 3,000 of those lighting it up this week, with nearly half, about 1,400 coming on Tuesday. The rest of the week kind of scattered. And as you might expect, it was kind of even from an open interest perspective. Really no opening or closing, kind of just a lot of back and forth, which is kind of interesting. You think if you pull away from that strike on the puts, you might see some net closing on this week, but that's not exactly what you saw out there. Followed by number two, hot on its heels out there were actually the 1280 puts. So a nice little put strip out here. 1270s and the 1280s doing about 2,500 contracts this week. The lion's share also on Tuesday, about 900 and change. The rest kind of scattered throughout the week. Then we go on out actually to Dees, the Dees 13.5. So it wasn't all puts all the time. It was some calls as well. The Dees 13.5 calls with about 2,400 and change, doing about the lion's share actually today, about 1,500 of that, nearly 2,500 going up today. The rest kind of mixed, only 24 going up yesterday. So a light day out there in the 13.5s yesterday. And then, of course, we also saw some action out here, kind of a little bit of an interesting scattering of action here in this. Usually we see a good chunk of it, and there was about 41% in the Nove contract, but a decent swath of contracts were active kind of across the broad first few months, including out there into Jan of next year, where we saw the 12-quarter puts also pretty active, doing about 21, nearly 2,200 contracts this week. Almost all of that, almost 2,100 going up today alone. So a lot of action in those 12. Looks like a 12-quarter, 12-half vertical may have gone up out here, because the 12-half puts also very active today with 2,000 and change, and a total of about 2,100 and change going up on the week. So my bat signal, my spidey sense telling me probably a bit of a vertical. Maybe Nick's got that up in his block trade report out there. And as far as the longer term contracts, like we said, the 17 halves did a little bit, and we saw 603 of the 15 halves out here in June of next year, June 2018. So a little bit more reasonable, certainly, than the 3,000 strike, but nothing super crazy as you might expect. So, Mr. Nick, any thoughts here on the skew you're seeing out here in gold, what we saw in vol, or maybe even that vertical that went up perhaps this week?
Yeah, so first thing I'll address is I just put a Volcone tweet out there to show what the constant maturity term structure looks like against 5 years worth of volatility data. And, we are, because I was more curious today looking at like the December contract, which is 45 days to expiration, and it snuck below 10% this week. So I was just curious as what the term structure looked like. And obviously we are on 5-year lows. So, I guess looking at it from that side, right? That crazy trade could be useful if vol happens to pop at all. The whole curve will pop, right? So then there's opportunity to do other things there, or, who knows? Maybe sell something closer, but not exactly sure still what that means. But I think that for me, that's what I'm starting to notice as we start to move out on the term structure, and what vol values, and how far out. When we're not quite. The 74-day, January is a 74-day contract. It's still above 10, but I'm going to take a look and see when the last time we were below 10 out like 90 days. So that's always that's interesting to me, given that 10 has been sort of like a low point as far as we've been watching of late. As far as the skew goes, not much change, not too much change in the first three contracts. Puts getting a little cheaper as we move out on the term structure, but nothing nothing tremendous in terms of overall vol values. And the calls, they got a little bit richer, but again, we talked about it last week. We thought that we had come off on the future quite a bit. So we were talking the same thing that we always do about how, or I think I was thinking about it and not necessarily mentioned, but I mentioned it almost every time we talk about gold, about when vol's low and we're down at the bottom of our range, you buy puts and you buy futures, right? And that's the same thing happened this week. You could have gotten away and got a good trade out of that as well. It seems like we have a pretty solid support down where we started over at 1275, maybe a little bit lower. I know that I think somebody I talked to about the gold stuff said that Goldman put out where they thought that gold would go down to 1150 or 1100, and I just didn't see it. But maybe they were trying to push it down so they can get in it, and maybe they are the ones running it up here. Who knows? But nothing super interesting there. I looked at all the block trades from just from a strike range standpoint for this week, and I think you're right in terms of I did notice there was a lot of 1300s, a lot of 1300 straddles traded today. So there's a lot of action at the money. So there's a fair amount of that going on. A lot of covereds traded as well. And what I did notice earlier, I think it was Wednesday. So you're seeing, you had people buying the put spread. You mentioned 25.75 put spread, so that was out there. But there was definitely, I'm trying to find it again. I thought I took a snippet of it. But there was a collar that was trading, and it looked like people were, I'm trying to remember what it was. There was a collar trade. I thought they were buying the puts and selling the calls in the gold. I'll have to go back and try to take a look as we're going through. But I did notice that there was, after that trade, I wanted to see what people were thinking. So, not near the range of strike trade this week, although I did see some in the 1700 range in the blocks. And I think I'm going to start looking out there more often, because that's obviously where the big trade occurred. And there's still plenty of electronic volume in those options, but nothing really spectacularly outstanding in the blocks that I noticed this week. And just as an FYI and a reminder to everybody, very soon we'll have the quick strike version of the CME block trade browser out on the CME website. Probably before the end of the month, it's likely out there, but you'll be able to go out there and really target what you're looking for and get a good idea of the range of strikes that are trading, and if they're trading as spreads and that type of thing. The current one out there is just sort of lists everything that trade. It doesn't really tell you what's grouped together. So, so nothing really interesting. Although I find it interesting that when it looked like gold was pretty soft last week, that we retraced back to where we have been trading up above the 1300. So for me, that's we're sort of establishing this wide range like we talked about. It's another commodity that's sort of within a range, and that's why the vol's so low. So, something to keep an eye on as we go forward.
Yeah, I like that 5-year lows. I know Eric will be talking about that next time we bring him on too. That's the first time we ever had him on, was when he came on with a research report he called Gold Storm on the Horizon. And it was very well timed, because he was talking about, record implied vol lows for gold, and a week later it took off. So perhaps we're in some interesting territory out there in gold. Certainly makes all you out there looking at some of these trades like collars or just premium buying in general, perhaps a little bit more attractive going forward. Speaking of attractive, crude was definitely attractive this week, with WTI end up the week up about 2 handles. So back once again north of that mythical, magical 50 handle. That 50 line is really so much of the demarcation line, the Mason-Dixon line out there in crude land. Everyone's watching it these days. And another week settling out above that level, right around 51.5 or so. up there. And of course, when we go upside, we see a little bit of crude vol come in, even though crude vol is getting squeezed already a bit at this point. Off another point and change this week, so a decent drubbing some places out there in the term structure. So not a lot of love for crude vol. All you people who keep writing in saying, when's the crude vol going to rebound? How much more of a drubbing can it take? Well, this week took a little bit more of a drubbing. So you got to be a little more patient if you're on the premium buying side of the fence, or perhaps look into some of those more risk mitigated type strategies with some short legs, some spreads, maybe some ratios to take advantage of some of that fun stuff. Speaking of what people were taking advantage of this week, it was actually interesting. A little bit more even spread to the trade where it wasn't all front month in the Nov. Nov and Dees actually accounting for a lot, about 70% of the overall volume, even though quite a quiet week out there in crude. Open interest only up about 2% this week. So not a rock'em sock'em robots week, but still some stuff lighting it up. And if you want to know where number one with a bullet was in both Nov and Dees, it was the 50 put. Pretty much across the board, that was where the action was. Almost similar numbers. Maybe a bit of a time spread here, Mr. Nick. I don't know. I'll have to look into the block trades to see for sure. But about 19,000 and change going up in Nov. Also a similar number, 19.9 and change going up out there in Dees. We'll start with Nov. By the way, of course, you guys, as always, can follow along yourselves, view the reports, click on the links, all that fun stuff. CMEgroup.com/TWIFO. TWIFO, of course, stands for this week in futures options. And I said the 50 puts out here in Nov doing about 19,000 and change. The lion's share actually coming today, about nearly 8,000 going up today. The rest of the week pretty scattered, 5,500 on both Tuesday and Wednesday, and only about 800 on Monday. Again, net kind of unched on the week, so only pretty much in terms of open interest. So a lot of back and forth on that strike. Also, let's pull up the Dees here, see if it's a similar story. Dees actually did a lion's share of their action actually on Wednesday with 12,500 of that 19, almost 20,000 going up on Wednesday, 4,000 on Tuesday, and the rest kind of scattered throughout the week. Again, also pretty much net unched from an OI perspective. So interesting stuff. A lot of back and forth froth there. Again, not entirely unexpected. That 50 strike is kind of where the action has been for some time out here in good old crude land. Let's go back to Nov here for a second. Yeah, number two were the 48 puts out here in November with about 14,500. The lion's share coming on Tuesday, nearly 5,000 going up. Then 4,000 and change on Monday. The rest scattered throughout the week. Also, interesting week. Not a lot of bias opening or closing in either direction. Kind of net unched from an OI perspective there as well, which is interesting. Not something we typically see out here. Usually you'll see a little bit of a bias one way or the other. This week, not so much. 52 calls, not to be left out of the action. 52 calls, also doing nearly 13,000 this week, about 5,500 lighting it up today, and kind of scattered throughout the rest of the week. Also, similar story. Net couple of hundred contracts opening, but that was pretty much it. So the rest of those contracts kind of churning and burning. And we dropped down to the 51s, almost similar numbers, about 12,000 and change. The lion's share coming on Tuesday with about 5,000 contracts going up. Then this one, a little bit more biased to the closing, about 2,500 of those contracts of that 12,000 and change being biased to the closing side. So there was some net action on the week, even though you got to dig a little bit to find it. The Dees 48 puts also fairly active, doing 13,000 and change this week, with the lion's share coming on Wednesday, about 8,000 going up there. The rest of the week kind of slight, about 3,800 or so opening net on that. So a little bit of a bias to the opening there. So interesting smattering of paper this week, Mr. Nick. Usually we see, like I said, a lot of concentration in just a front month, maybe Nov or whatever. This week seems a little bit more action across the board. Let's dig out a little bit farther, see if we can see anything interesting or outlandish way out there. Looks like the 57s in Jan trading about 8,000 times this week. So interesting. Not 57 in Jan is not as outlandish as perhaps it may have seemed. Certainly not as outlandish as the June 70s trading 3,000 times and change. Fairly even. 1,000 on Monday, 1,100 on Tuesday, and 1,000 again on Wednesday. Pretty much most of that opening. So someone opening for pretty decent size on the June 70s out here. You guys agree with that? You guys in the oil bull land? I think we've talked for a while here about we had that range here around, and I think it was Matt who called for a top around 52. That seemed to have held out for the better part of the last few months. Our friend here, whoever's opening on these 70s, perhaps taking the other side of that bet, saying, nope, 70 by June of next year. And not to be left out in the dust, the puts were trading as well. A little bit longer term here. The Dees 2018. 40 puts lighting it up to the tune of about 3,500. 1,500 going up today, about 2,000 going up on Tuesday. About 2,000 of that or so opening as well. So some more opening action on the 40 put. So kind of a bit of a pick 'em. You know, wherever you look, you can find some fun stuff, including Dees 2020, someone picking up 500 of the 80 calls out there in crude. So an interesting smattering across the board, Mr. Nick. A lot of interesting stuff going on here in crude this week. A little bit more, I think maybe a little bit more even spread to the trade this week. Anything catching your eye out here in the skew, or maybe some of these funky trades you saw going up this week?
Oh, I think you got it covered pretty well in terms of the stuff that I was going to point out. The 70 calls in the June 8s and the 40s in the December 8s, 18s. Those seem to be the widest strikes that traded. You know, looking at the blocks, there was a lot of collars that did trade, and I think a majority of them appear to be where people are selling the puts and buying the calls. Although I did see some put buying with some sell calling as well. Those tend to be a little bit tighter. The wider ones look like they were selling the puts and buying the calls, and the tighter ones look like they were selling the calls and buying the puts. So sort of a short-term, long-term play there. But yeah, I mean, again, same thing. You know, it's a broken record, right? We're really not. I sent out a cone for 5 years on the crude oil as well. We're not quite as low as we have been. Now you gotta take that with a little bit of a grain of salt. In that, I did a 5-year range. We had futures up in the 80s, 90s, and near 100 during that time. Volatility was a lot lower then, but that volatility encompassed a greater price range in the futures, right? So, you know, maybe we narrow that down to something more recent where the futures price, I'll take a look at that and try to push it out where the futures price wasn't quite as high. So if I go in, I'll take a look and I'll tweet this if it looks any good. Yeah, so if we start looking inside of 3 years or 3 years, and then we look at even 2 years, you know, we're near our low. So when you know, within the trading range that we've seen over the last 12 to 18 months, volatility is at or near the lows from a consummatory standpoint, which implies that it's like that from a listed futures option standpoint. So, you know, we kind of have to look at it almost as two pictures, one at the high futures price and one at the low futures price. But as far as anything interested from a volatility standpoint, I mean, outside of the fact that vol was off a pretty fair amount this week across the board, and that's as we come back from being, you know, like we always say, you know, we say we like a 4% move, but really we want a 4% move in a direction we haven't been, but we had a 4% move back in the direction where we just came from. So nothing really great there. Vol's going to get sort of pounded down as it has, you know, off, you know, around, it was off today quite a bit, 1% in the front and 0.5%. Et cetera, as we go out in the term structure. So, you know, we're going to trade in the range, and people are going to get excited if we get near the bottom or you know, start to maybe think we have a move up. I don't see it right now. And again, I don't. A guy like you know, the guys we talk to who actually have customers that are trading it have a better indication. But just from looking at the technicals and the open interest and the trending and the volatility, I mean, I still think people are poised more for a downside move given the way the vol curve looks. But you know, nothing tremendously exciting. I mean, you mentioned not a great deal open interest change, but still increased open interest. Those 70s were an open. The 40s that you mentioned were an open. So you know, that's new stuff going on out there. And you know, outside of that, not much. Vol lower, keep it. Same thing. You know, it looks like, it just looks like we're going to trend around for a while until something significant occurs or whatever that may be.
That does seem to be the case. Let's see if we can find some interesting winners and losers as we parse the full suite here of products trading over there on the CME. Let's start off with just net. Which underlying had the best and worst weeks? What was moving, what was shaking, what was rocking, what was rolling? Number one with a bullet on the upside, Nat Gas, up 10.2%. Remember, this is just underlying. This is not vol or anything else. Palladium, number two, 7.5%. Coming up, number three, oats, 6.25%. WTI actually number four, nearly 5%, 4.85%. On the downside, we got our old friend Class 3 milk off 2.5%, and then wheat off kind of fractionally, but 0.85%. percent. And I'm not sure what that spread there is with the U.S. dollar. I'll have to pull that up a little bit. But the currencies there on the downside off about 2.1% too. Let's also parse it a little bit, see what's winning and losing just from a net, options volume OI perspective. What's gaining, what's losing OI this week. And the big gainers actually were our friends over there in the E-mini Russell. Mr. Nick, as well as the E-mini S&P, both of them gained, looks like about 4% this week. Again, if you have smaller OI numbers, it's easy to grow on that, so bear that in mind. But still, interesting stuff out there as well. Also seeing, again, some interesting action in the currencies, Aussie dollar, USD, and some others up about 3% this week from an open interest perspective. So in a time when a lot of big trades weren't really moving the OI needle in WTI, some other products we're getting a little bit of action. And what was closing, what was losing OI this week, we talk about euro dollars. That's kind of always on that list, so we'll bump it off. It's partially due to the way that data is kind of parsed and collected. So let's look over here to the 2 years. 2 years looks like they were off a little over 1% this week, and that was the biggest loser on the week from a net OI perspective. But you know who's never a winner and loser, at least when it comes to this show? It's you guys. You guys got such great questions and comments. So let's get to them. It's time for some of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback, the point where you guys hit us up, questions, comments, insights, pearls of wisdom, all that good stuff. You guys know how to find us. They just broke it down for you on the social medias, the email, the website, all that fun stuff. By the way, on the social media front, if you guys are not following Nick and the team at Quick Strike over there, you should be. It's at Quick Strike 1. No K, remember, QUIKSTRIKE1. Nick, I love these vol cones you're tweeting out. I was just talking with someone about vol cones the other day. It's such a simple tool, but they're very effective. If you're not familiar with these listeners, they're effectively like a Bollinger Band for volatility. They show you kind of where your vol is in a range to the mean, and one standard deviation above and below, and it gives you a nice idea of where you're trading on that curve. It sounds like, Nick, you guys are big fans of vol cones there as well, sir.
Yeah, I used those quite a bit when I was in the Eurodollar options, because it was a nice way to get an idea of where the different parts of the Eurodollar curve were. So especially when the short dated, the mid curve options, they're called now the shorts, we call them then. I think they're still called shorts, but mostly they're called mid curves. It was a way to really get an idea of how they were priced in comparison to the longer dated options of the same color. So yeah, I like those. It is a good perspective because what you can do on that cone as well within Quick Strike is you could plot the current listed contracts against the counts maturity ones, and typically they're in line because that's how the numbers are being built. But occasionally you'll see it be out of whack, and you can get an idea of if there's some sort of calendar spread on or something that might be a good opportunity to put that vol spread on. So yeah, we do like them. We like all things volatility. We like to look at volatility a lot, and because volatility makes the world go round or your stomach turn, however you want to look at it, right? So depends what it is.
It does depend on a lot of things, including your questions. We've already got some of your thoughts here on the craziness that was the gold zombie apocalypse trade. Let's see. You guys also got some. Let's see. TMD 4817 wants to know, what is a better time frame for maxing out a 1 to 3 day quote swing trade with options? Do you like weekly expiries versus out 1 month versus out 2 to 3 months? We get a lot of questions on this kind of frequency. I think maybe it's because it's like the futures options mindset. They like that swing trading. So we get a lot of questions on the swing trading using options for whatever reason here on the show, Nick. Yeah, well, this is an interesting one. 1 to 3 days, it's going to kind of obviously rule out a 2 to 3 month time frame. It's probably even going to rule out really a 1 month. You could obviously do it. It would work with a 1 month. But I think when you're talking that short of a duration trade, you want a lot of gamma. You want a lot of high pop bang for your buck. So the shorter duration you get, the more gamma you're going to get. Also, the more decay you're going to get. Gamma and theta are flip sides of the same coin, so bear that in mind. If your trade doesn't play out in the time frame you're talking about and you're playing with weeklies, by the time day 4 rolls around, your weekly could have eroded to the point where you've lost a substantial amount already. So you got to be pretty sure on your time frame. But it sounds like from your question you are. So if you're pretty sure on that time frame, then weeklies are going to be the cheapest outlay, be the most gamma in terms of bang for your buck from that perspective. If you go out beyond a couple of months, you're talking your gamma is going to come down. Remember, as you get closer to expiration, the gamma increases. At the money is going to have the highest gamma, highest theta. So somewhere around that range. You don't say exactly what kind of move you're looking for or what direction or anything like that, so we can't get a little more specific in terms of maybe some directional trades or things like that for you. But definitely, if you're looking for that kind of near-term bang for your buck, you need gamma, so you got to play in the weeklies. Monthlies, that's as far out as I would go. I wouldn't go beyond that if you're looking to really do some aggressive 1 to 3 day trades. Mr. Nick, any thoughts on this one, sir?
Yeah, I would tend to agree with you. I mean, you can't, you're really not going to get any benefit out of the 2-3 months, right? Because you just don't have. I mean, now it depends, right? In the old days, the 1 month and the 2 and the 3 month were all that you didn't have any weekly stuff, so you probably were looking at the 1 month, and typically you were, if you wanted a gamma, you were doing the 1 versus the 3 or the 1 versus the 6, right? So you'd be short vol and long some gamma, but now you basically can get an expiration. Well, in the energy department, you can get an expiration that happens every day, so you can swing within a day if you want to, if you think that there's some chance for activity, and a lot of days there are in some of these energy products. So I'd say again, we talk about it all the time, a 1 to 3 day swing trade. You're really starting to look at an option not really as an option. You mentioned it has decay, which it does, but you're really starting to look at it as just almost like a binary. You think it's going to go one direction or another. So I would say that the 1 to 3 day weekly is your better choice. Although some 1 month, if vol's low enough, a 1 month might be useful, because if vol's low enough, you're going to get a lot of gamma on that because the vol's low. So you might have some opportunity with that one as well.
Yeah, and another good, you brought it up, another good point for this question really is that this is the best time to be asking questions like this, because a few years ago you didn't really have the swath of the weeklies that you have today, not just week 1, week 2, week 3, week 4, but also Monday weeklies coming in now and Wednesday weeklies. So you have a lot more in terms of nuance and choice now than you did even a few years ago. So if you're looking to do these these short-term swing trades, you got more choices, more options, pun intended, than ever before. So this is a good time to be looking at that kind of stuff with options. Whereas in the past, you really only had 1 month options, and that was kind of it. So be thankful for those that proliferation of choice. Here's one that came in, Nick. This came in last week when I was doing kind of an AMA thing over there on Twitter from Patrick Rooney. I thought it was a good one to kind of discuss on this show as well. He wants to know, do you guys use futures in your strategies for hedging, perhaps? If so, which? And he wants to know, do we use the E-minis or the big S&P futures, or some of these other ones out there? I talked a little bit about this before, but Mr. Nick, you obviously were out there in the Eurodollars for a while, so you kind of come to this more from a futures background than I do. We started on the equities. I used a lot of S&P futures to hedge in the SPX. That was our primary tool. This is before the E-mini really took off. So the S&P futures were kind of the big futures, were kind of the only game in town. Now you can hedge a lot more aggressively with the minis, and the size restrictions are gone and all the other issues that confronted that product back in the beginning. But I'm curious, you still slinging any futures in your daily trading? If so, what are you doing?
Well, if he's talking, we talk about it all the time, and I think Patrick's at TT, to be honest. I think that's the same guy. We talk about futures in our strategy all the time, right? Because if anybody who's listened long enough, I like to do, like we just said, we like volatility, and I like low volatility in both the puts and the calls, or a low, a vol curve that has some tilt to it, because I feel like those are when you get the greatest opportunities from a volatility with a hedge position, right? So if you have a vol curve where the calls are cheap, and you're near the upper portion of a range, you can buy those calls and sell futures. And if we move down at all, you have a lot of gamma to work with, and you can take those futures and get a lot of the premium that you put into that call and get it back with that move down, right? So so I like strategies from that standpoint. And you hear me all the time talking about the gold market in particular, and the oil market when we near the bottom of a range or we bounced off the bottom. I like the puts and I like hedging them because same thing. We have if the market continues to go down, you got in at a volatility level that's pretty reasonable, and you're hedged, so you get to lock that in. And if the market moves up, you have gamma to work on your side to get some of your premium back and scalp out of some of that to benefit the fact that you were at the lower end of your range and you're moving back up into the center. So yeah, I'm not the only time I'm not really necessarily well, not even then. I mean, based on the quick skew trade, as we like to call it, when the curve's out of whack, I even like hedging it then, not necessarily with futures, but with the synthetic at the money. So I guess technically you could say that I tend to think of, for whatever it's worth, being trained as a vol trader, you're always looking at vol edge, which means you're going to hedge. So I'd say most of the time I'm thinking about using futures or some sort of synthetic to put on the strategy.
Yeah, it's funny. I hadn't done a lot of futures since I left the SPX pit, and doing this show now has kind of lured me back a little bit to the dark side. I think exactly what you were talking about, that notion of some of these products like gold and others, really being so well suited to collars and other trades like that. If I am going to do an underlying type trade, it probably would be in that capacity with the collar portion to hedge it and things like that. Or sometimes I'll use maybe a nice short put or risk reversal, try to get some sort of exposure to the underlying with or without the underlying component itself. And if you get the futures put to you can always turn around and use the old wheel trade to get out of it as well. But I'm with you. Kind of some of those products that really line up that well, like a gold, and others, I'm not as reticent to as just diving in and buying and holding, let's say, an S&P future or something like that. We all know how that works out, and it's worked out well lately. But other than that, the hedging and going against the collar shape and the skew shape out in the S&P, not quite as attractive as, shall we say, some of the other products out there. All like gold. Here's a silly one, Nick. This has got to be for you because you're the soccer guy. I'm not the soccer guy. Opening Bell wants to know, which English soccer team do you support? Is it MANU or not? I guess a very binary choice. You're the soccer man, Nick. Are you a MANU guy?
Well, I think. My short answer is yes. So my wife and my kids and my wife's like a MANU soccer junkie, so she could tell you everything about the roster and the transfers and all that kind of stuff. So I'm a MANU fan. I'm also a Rooney fan. We miss him, but his time was kind of at its end on United, but we still are watching him. I like all English Premier League soccer personally, and we'll watch that over any American sport at this point. Except maybe playoff baseball, because I won't watch baseball during the regular season. But yes, huge MANU fan, and it's probably a lot more about my sports preferences than the audience needs to know, in all likelihood.
I knew this one had to be for you because that's just that's not my wheelhouse at all. So good question. Send your soccer questions to Nick, listeners. All right, GGLee. They have a collar question. We're right up our alley. We're just talking about collars. He says, or perhaps she, buying collars means buying skew and paying up. Okay. He goes on to write, so does it stand that the best SPY trade is selling skew by selling 25 delta puts and buying 25 delta calls? Maybe add a cheap hedge with a 5 or 10 delta put in case the worst comes to pass. Right now I can sell the S&P 25 delta put for about 55 cents. Buy the he's talking October. Buy the October 25 delta call for about 55 cents, and then buy the put hedge for about a net 20-cent outlay. Thoughts? Yeah, you're that's kind of getting to what we were talking about before with you have to trade these products in ways that are favorable, that give you advantages, and just being another person who's coming out on the S&P and collaring the S&P, buying the put, selling the call. Guess what? Everybody is doing that. So you're paying up from a skew perspective, and so that's going to disadvantage you out of the gate. So yes, turning that around on his face. I love what you're detailing is effectively a reverse collar, aka a bullish risk reversal. One of my favorite trades, and it works. It's a great way to approach the S&P 500 because you're doing exactly kind of what we were talking about before with the underlying. In this case, you don't need the underlying. You're getting bullish deltas. In this case, about a 50 delta minus the put hedge you're buying, of course, so maybe about a 45 or a 40 delta. Still, you're getting a net bullish deltas, bullish exposure on the underlying with a nominal outlay. You've made the skew work for you instead of against you. So I like this, and you're also doing it in a very risk mitigated fashion. So in case, obviously, the risk in this is the S&P just takes a dive while you have this on, in which case you got that put on to hedge yourself should the worst come to pass. So you're coming on to what a lot of people have hit on in this space. So that is the way a lot of people like to trade this product. It's, the bullish risk reversal works. It's beneficial. You get the deltas for all the rally that you're going up. If the worst comes to pass, you get the underlying put to you. You can wheel out of it, or if it's a big dive, you got the put here to really protect you. So yeah, I'm not averse to that trade at all. This is kind of like the opposite of what we were talking about with the gold. With gold is very favorable for collars. S&P more favorable for the bullish risk reversal, I think. Mr. Nick, your thoughts here on GGLee. I'm not sure if I'm pronouncing that correctly, and their S&P collar suggestion.
Well, it could actually be GGLee, right? So instead of
it could be GGLee.
It could be GGLee. As far as adding anything to what you said, I don't know that I necessarily can there. The only thing I would question is terminology in terms of buying collars means buying skew. I guess if you're paying a premium, you're going to be paying more for one versus the other. So I don't necessarily look at it as buying skew all the time, because I don't know. I think it's that's just a semantics thing. But yeah, what you said, I agree with what you say. It's a good way to cover yourself if you think that the place you're going to get in trouble is on the downside. And it's interesting if the puts bid and the calls are offered and you're getting them for the same premium, same distance out. So yeah, that seems like a pretty decent way to look at it, and I think your explanation is as good as it's going to get.
Yeah, I didn't check his math on that. I'm assuming his numbers are correct. It does seem a little interesting, those prices, but we'll leave that as it may. And I think that terminology of buying skew, I think that's a very S&P centric way. That's what we used to call it. And on the SPX, typically when you're buying skew, it's termed around the put wing. So you're buying the puts or you're selling the calls, or vice versa. That's kind of how. So he must be looking. Obviously, he's writing about S&P, so he's looking at it from an S&P centric mindset. Obviously, that definition doesn't really hold if you're talking about some other products where the skew is very different. But in terms of when people say usually buying a skew, usually they mean S&P, and they're talking buying that put wing, which is exactly what he's talking about. All right, let's wind down here on a fun, silly one. We always got to get our Bitcoin in. This one comes from Cham. I like that handle. Cham. Oh, you got one more to add here on the skew, sir?
Yeah, just I'm just curious. If he could send us like where he or she has where the puts are bid and the calls are offered and the 25 deltas are the same price. I don't know how he's getting or she's getting that, because let me look at the shorter dated one here. Look at the 28-day S&P E-mini, and when you have the puts, when you have skew to the downside, you're not going to get your put and your call price the same thing. So that tells me there's a smile on that SPY and not a skew. So I would check the math there, because my guess would be if you're selling the put and buying the call, you're getting money. There might be zero outlay. There's got to be something wrong with that, because I would say he or she's selling the put, buying the call, and then using the premium from selling the put and buying the call to buy the smaller put behind it, because you're not going to get a 25 delta where the vols bid on the downside for the same price as the upside.
Yeah, so usually if you're doing a zero cost collar in the S&P, you got to play with those strikes a bit. So you're not going to get quite straight same delta. It's going to be, obviously smaller delta on the put and maybe tighter on the call to get that all to line up in a zero cost capacity. Certainly in the S&P, it's going to vary by product. That's why, I didn't think those numbers lined up, but I don't want to call a question to our friend GGlee. I was talking more, conceptual on the actual, but this came in, I think, earlier this week, so I'll have to see maybe where he or she pulled this from. But conceptually wise, certainly if you can get that, that's good pricing. I don't think you can. But conceptually wise, I think the theory is sound. If the pricing may be a little bit, maybe he was looking at different expiration months. He doesn't really say, or she, which he doesn't say that in his question, but that could also be the case too. All right, let's wrap up here with Mr. and Mrs. Cham. They say they think we missed the boat last week, Nick, calling us to task a little bit on Bitcoin skew. They say only crazies trade it, and they are long for size, so the call skew would be nuts. This is interesting, Nick. I had the guys from Level Trading Field on our interview show this week. I think that's hitting the network now, so you guys listening live can listen to that right now, actually. And they have a Bitcoin predictor on there. So I was asked him, I put him that question we got from a listener last week. I said, what would you envision the skew to be like out there? And he said, pretty much the entire use case for their predictors, people coming in and wanting to predict higher and higher levels, and just effectively what would be effectively buying calls if there were listed options. So he kind of made, he said it was kind of analogous to back in the old days of the Apple, when people were crazy for Apple and things like that, or the gold bugs, where they kind of just got to have it all the time. So he made it sound like the call skew would be super crazy all the time. Remember, we were thinking last week that it might be more like an index skew, where the puts would have some big because people want to hedge, and the calls maybe not so much. But the wild card we always said was, what about the crazies? Are they going to overwhelm the skew? And he made it sound like perhaps they would indeed. So there you go, a guy with some data on it. I know you got some data on this as well, Nick. Have you evolved your opinion on what the potential Bitcoin volatility skew would look like?
I'm not. I mean, again, I could see the argument that the call skew would be nuts, but I don't necessarily think that, because anybody that I know that trades the cryptos, they buy them to sell them. So they're so. My guess is that that's not going to be as out of sight as people necessarily think. And when you look at the distribution of the prices, like we were talking about last week, it's a pretty even smile from that standpoint. But again, most price distributions are. But I think that you're going to see as many people offering the calls that are long the underlying as people who are outright purchasers of the call options. So I think that's coming from somebody who's not long the underlying, and somebody who just wants to participate in the frenzy of Bitcoin, thinking that I'm just going to buy calls because it does nothing but go up. But once that opportunity comes to start buying calls, you're going to see the people who are long that market offer that up in pretty good size, because if they're long from 3,000, they could sell 5,000 calls at a super huge premium. They'll gladly take a 67% return on something that they did, right? So I'm not buying it yet. I'm not buying it. And that predictor thing, that's a crowdsourced predictor over on level trading field. So that's kind of just going to be biased based on the small audience that they do have that's actually looking at that tool. So I'm not sold on that either.
All right, what you are sold on, though, is that we got to bring this show to an end. You're right. If you're playing with the Bitcoin predictor, you probably got a little bit of a sample bias and selection bias in there as well. But still interesting to see the data, because we don't really have a lot of data yet, or really any data on this. So it's anybody's guess as to how this would look. I'm curious to how that crazy component. I'm kind of with you. I think people will be looking for an exit, and the options would allow that, hence, or at least some hedging, hence a nice bid to the puts. But you got those call crazies out there, and they're always a wild card. Well, before we go, Mr. Nick, you guys are always cooking up cool stuff over there in the land of Quick Strike. What you got on the docket for us this week, sir?
What do we got in the docket? Let's see. More good stuff. I mean, you got to look for our new tools that are coming out this month on the CME, product browser with expiration finder and the block trade tool. And if you haven't looked yet and you haven't registered for Essentials, you got to take a look at the free quick follow tool that's out there, giving you 1 month of data. Right? I think that's going to make everybody happy. And then coming soon, we got this. And it's been a long time coming, and we worked on it for a significant amount of time. We're going to have a nice strategy builder that's going to be replacing the existing strategy builder, and we'll have a free version that's out there as well. And I think you're going to like that. It's pretty sweet.
There you go. Check it out. The easiest place, of course, to kick the tires on those tools, cmegroup.com/TWIFO. That's where you can get those reports that Nick and I use, and you can click on over to get the Quick Strike Essentials and begin your journey from there. And as you keep going down that path, you get access to more and more of this cool data that we're using all week. And if you like these markets, and I'm guessing listening to the show you probably do, then you should be checking those out. So thanks for joining us here this week on TWIFO. And on behalf of Mr. Nick and indeed myself, I thank all of you out there for joining us. Of course, for downloading, for streaming, subscribing, for sending in questions, for all the fun stuff that you guys do. And we'll see you here next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.